Hello, welcome to the Chapter 9 problem solving session. So we're going to look at the depreciation, depletion, and amortization problems that I've assigned in Chapter 9. Let's start with straight line depreciation. So we have the acquisition of a building, and we need to determine three things: the depreciable cost, the straight line rate, and the annual straight line depreciation. Let's get started with the depreciable cost. So the depreciable cost represents the cost of the asset minus the residual value. That's all the depreciable cost is. The cost of the asset minus the residual value. Depreciable cost is cost of the asset minus the residual value. So in this case, let's see, that depreciable cost, we've got an asset that costs $1.8 million. And there is a residual value of $200,000. So the depreciable cost is 1.6 million. That's our depreciable cost, 1.6 million. And what's the straight line rate? The straight line rate of depreciation. Well, the straight line rate of depreciation, we always determine the straight line rate by taking 100% divided by the estimated useful life. 100% divided by the estimated useful life. So the straight line rate, 100% divided by the estimated useful life. So what does that give us? Well, 100%. So let's see here. I could get this. That's going to equal 100% divided by an estimated useful life of 20 years. An estimated useful life of 20 years. So we've got a straight line rate of 5%. A straight line rate of 5%. And in C, we need the annual straight line depreciation. So the straight line depreciation, we're going to use the first number we calculated, the depreciable cost. We're going to spread that depreciable cost. So if I could here, we're going to take that depreciable cost and we're going to spread that over the estimated useful life, such that what we end up here is when we take that 1.6 million of depreciable cost and we spread it over the estimated useful life of 20 years, what that means is we annually should have depreciation of $80,000, and that should be a dollar sign. $80,000 is the annual straight line depreciation. Annual straight line depreciation of $80,000. Let's look at the units of activity method. So the units of activity method, again, we need the depreciable cost, the depreciation rate, and then the actual depreciation for the year. So the depreciable cost in Part A. The depreciable cost in Part A is cost minus residual value. So in this case, we have a truck that cost them $60,000 to acquire, and it has a residual value of $2,000. So that means that our depreciable cost is exactly $58,000. And the next thing we need to know is the depreciation rate. The depreciation rate. So the depreciation rate, when we use this units of activity method, so the depreciation rate, well, that rate is actually going to equal that depreciable cost, but we're going to spread it over the estimated useful life in terms of the activity. So we're going to take again that depreciable cost and we're going to spread it over the estimated useful life. So what does that mean? Well, the depreciable cost we already know is it's the first thing we determined, $58,000. So that depreciable cost, we need to spread over the estimated useful life. And what they anticipate is that there should be a useful life of 200,000 miles. So the depreciation rate is 29 cents a mile. And if we want to know how much depreciation should be recognized, well, the depreciation expense should just be the rate times the activity, right? We're just going to depreciate based on the rate times the activity. So the rate, right? The rate is 29 cents. And the activity, well, the activity was 15,000 miles during the year. 39 cents times 15,000 is 4,350. That's our units of activity method depreciation expense for this first year. Two-step process. Find the depreciation rate, in this case, 29 cents, and use that rate times the actual activity. Let's look at the double declining balance method of depreciation. So we need the rate first. We need the DDB rate. Well, the DDB rate is based on the straight line rate. So we need to find that straight line rate first. So in this case, the straight line rate, that straight line rate is based on 100% divided by the estimated useful life. So we need 100% divided by and I'm just going to abbreviate the estimated useful life. So essentially what we're saying here is we've got 100% and we want to divide it by the estimated useful life, 40 years. And what that equals, 100% divided by 40 years is 2.5. 2.5%. And the DDB rate, well, it's a double declining balance rate. A double declining balance rate. That means we double whatever the straight line rate is, right? So in part A, double declining balance rate is 2 times straight line rate. And we just determined here that the straight line rate is 2.5%. So 2 times 2.5% is going to give us the DDB rate of 5%. That's our DDB rate. And now let's determine the depreciation for the year. Well, we've got to use that DDB rate now. The DDB rate is based on the book value. The double declining balance depreciation is based on whatever that book value is times the DDB rate, right? Whatever the book value is times that DDB rate. So in this case, we have a book value at the beginning of the year that just equals the cost. Because at the beginning of the year, we haven't done anything yet. We haven't depreciated. So we have 3,850,000, and we want to multiply by the DDB rate, which is 5%. So the DDB depreciation in this case is 192,500. That is our double declining balance depreciation expense for the first year, 192,500. Next, let's look at depletion. So we've got some mineral rights that we need to report depletion for. So it's a two-step process. We've got to find the depletion rate first. So the depletion rate in Part A, the depletion rate is going to be equal to the cost divided by the deposit. So the cost divided by the deposit, the amount we think is buried in that natural resource. So the cost is 494 million, right? And the deposit, the amount that we think we're going to be able to extract, is 475 million tons. 475 million tons. That means that we've got a depletion rate of 1.04. And if that's the case, then the amount of depletion that we should be recording, the depletion expense, should be the rate times the actual removal. The rate times the actual removal. So the rate is 1.04, and the tons that were actually removed, 31,500,000 tons. That means the depletion expense should be 32,760. That's the amount of the depletion expense in Part B. And then lastly, in Part C, we need an adjusting entry to recognize the depletion expense. Well, depletion expense is an asset, right? So the 32,760 is the depletion expense, and we want to record the depletion. Okay. And that's how we account for depletion. Let's take a quick look at amortization in exercise B-98. So the first thing we have is to record the acquisition of a patent. So they bought a patent, and we have to record the transaction for the acquisition of the patent. Well, the patent, and I should be able to do that right here, was acquired on April 1st, April Fool's Day. So we acquired the patent for a cost of $1.5 million. Debit the asset for $1.5 million. That's the cost of the patent. And of course, the payment, cash count, $1.5 million. So that's A. And let me just move that down here, because that's where that is. And then the next thing is going to be B. So for B, what we need to do is journalize the adjusting entry for the amortization of the patent rights. So in B, right, amortization, The amortization expense is straight line amortization, right? So the amortization expense here is straight line amortization. And what that means is we're going to take the cost of the asset and divide it by its estimated useful life. So the cost of the asset divided by the EUL, the estimated useful life, is the amortization expense. And in this case, the cost of the patent is 1.5 million. And we want to divide by its estimated useful life, which is 12 years. So what that says is we should be recognizing $125,000 of amortization per year. January through December should be 125,000. But this asset wasn't purchased until April 1. So in the first year, we don't need a full year of depreciation of amortization. We just need to make sure that we have amortization that applies to April through December, which is 9 months, right? So we need to multiply that times 9 out of 12, and that'll give us the amortization for um, the portion of the year when the patent was actually outstanding. So this ends up being 93750. That's the amortization for April through December, 9 months of amortization. So the amortization expense in B on December 31. Well, that amortization expense we know should go in an account called amortization expense. 93,750. And that gives us our amortization. And then the last thing we need is the adjusting entry for impaired goodwill. Oh, I'm sorry, I didn't fill in the rest of my entry here. The credit always goes to the related asset account. We're going to credit the patent account. And now what we have here is in part C, we need the adjusting entry for the impairment of goodwill. $6 million worth of goodwill was impaired. And we know we can't recognize all of that as an expense. We can't go back and turn the tables, but what we can do with goodwill is if there's a loss, we want to recognize it as soon as we know there's a loss. And it's that 6 million. And of course, it comes straight out of the asset called goodwill. So we looked at the acquisition of the patent, right? Debit the asset account and credit cash. We looked at amortization of the patent, which is just straight line amortization, the cost of the estimated useful life. And we looked at the impairment of goodwill. So the goodwill is thought to be impaired by $6 million. We want to make sure we recognize a loss account for this goodwill and credit the goodwill account. Let's go back and take a look at straight line depreciation. So we need to know the annual amount of depreciation using the straight line method. So again, the straight line depreciation, right, should be based on the depreciable cost divided by the estimated useful life. So the depreciable cost, and we want to take that and divide it by the estimated useful life, the EUL. So in this case, what we have here is we have 80,800 divided by 8 years. And what that ends up equaling for us is $10,100. That is the straight line depreciation for this asset. Straight line method is the easiest method. It's very straightforward, very easy to understand and follow. DDB, not so much. It requires more than one step. So the next exercise is the units of activity method. The units of activity method. So the depreciation rate, in this case, we have a depreciation rate, and that is going to equal the depreciable cost over the estimated useful life. The depreciable cost over the estimated useful life. So what have we got here? What we have here is a depreciable cost, which is the cost of the asset of 115,000 minus the salvage value of 10,000. And that ends up giving us a depreciable cost. And I'm going to put some brackets around this, and then all we want to do is we want to divide by that estimated useful life. So we want to divide by the estimated useful life, which is 28,000 hours. 28,000 hours. That's what they give us here, 28,000 hours. So what we end up with is a rate of $3.75 per hour. So the depreciable cost spread over the useful life, and it's $3.75 an hour. So that means that the depreciation expense is just that rate times that rate of 375 times the actual activity times the actual activity. So this 3.75, we want to multiply times the actual activity. So actual activity, they only operated the tractor 160 hours. Which means we have actual depreciation, in this case, of $600, right? That's the depreciation expense using the units of activity method. Two-step method, find the rate, and use the rate. So now, in the next couple of problems, we are going to compare methods and calculate depreciation, in this case, for the first 2 years. So in exercise 9.9, calculate depreciation for each of the first 2 years, A, using the straight line method. So using the straight line method, we know that depreciation should be based on a fixed amount for each year. So we're just going to take that 100%, if you will, and divide by the estimated useful life of 2 years. The estimated useful life of 2 years. So 100% divided by 2 years. 100% divided, I'm sorry, the estimated useful life is not 2 years, it's 10 years. We just need to depreciate for those first 2 years. But the useful life is actually 10 years. And 100% divided by 10 years is 10%. And then we're going to multiply that times 2 because we're using twice the DDB rate. So 20%. 20% is the DDB rate. So the DDB rate So let's see, what did I do here? I didn't mean to do that. Okay, there we go. So the DDB rate, the DDB rate is again, it's twice the straight line rate, and the straight line rate we just determined to be uh I'm sorry, I must have covered up something. The DDB rate, no, I put this in the wrong place. So in this case, what we need here is just an equal sign, because what I've done here is I've calculated the straight line rate. 100% divided by 10 years is 10%. And the DDB rate, so this, if I could move this here over a little bit, the DDB rate is that straight line rate of 10% times 2. So we have the DDB rate, and in this case, there is no residual value, right? So this problem starts out by telling us that there is no residual value, so we don't need to worry about that. And in part A, let's find the straight line depreciation. So the straight line depreciation, again, is the depreciable cost. The depreciable cost. And there again is no residual value. So the depreciable cost in this case, cost minus residual is what we would usually do. Right. And then just divide by the estimated useful life. That's how we get the straight line depreciation. Cost minus residual over the estimated useful life. So again, the asset costs $90,000. There's no residual, right? So minus 0. And then we want to divide by the estimated useful life, in this case of 10 years. Take that $90,000 and divide by 10 years. That's what we've done here. Take that $90,000 cost and spread it over 10 years. So what we're saying here is the straight line depreciation, right? That 90,000 spread over 10 years is exactly $9,000 of depreciation. That's the straight line depreciation expense. And it'll be 9,000 for year 1 and year 2. Year 1 and year 2. But when we use the DDB method, well, DDB depreciation, remember, DDB depreciation, and we've already got the rate. That straight line rate of 10% times 2 is 20%. So that means the DDB depreciation needs to be, and let me just copy this over here. The DDB depreciation needs to be the book value at the beginning of the year times the DDB rate. So let's go with year 1 first. in year one, the book value at the beginning of the year is just the cost of the asset, right? The cost of the asset, 90,000 times 20%, which is the DDB rate we determined up here. So what we can say here in this case is the first year depreciation is 18,000. 18,000, again, it's the book value times the DDB rate. And now we get to year two. And what we want to know is, again, what is the depreciation? Well, we got to find book value again. So the book value is the 90,000 minus the 18,000. 90,000 minus the 18,000 is the book value. And we want to multiply that times the DDB rate of 20%. And 90,000 minus 18,000 times 20%. And what that works out to is 72,000 times the DDB rate of 20%. So what we can say is that depreciation in year two is the $14,400. $14,400. Depreciation the first year is the book value, which is just the cost, times the DDB rate of 20%. We found that up here. And then the next year, it's the new book value at the beginning of the year, which is the 90,000 minus the first year depreciation. So in the second year, it's $72,000 as the book value times the DDB rate of 20%. And that allows us to compare the straight line rate with the straight line method with the double declining balance method. And we have just a couple more left here. So again, comparison. So in A, if we are asked to find the amount of straight line depreciation for the, in this case, the first 2 years, year one and year two, well, the straight line depreciation expense is it's just the cost over the estimated useful life, right? It's the cost over the estimated useful life. So that's all we're going to need here is the cost spread over the estimated useful life. Cost spread over the estimated useful life. And we've got an asset that costs $90,000. And there is a residual of $12,000, right? So now I've got a residual of $12,000, which means that we have, in this case, a depreciable cost of $78,000. And remember this depreciable cost, right? I put brackets around this. This depreciable cost, we need to be spreading over the estimated useful life. So we have a depreciable cost of 78,000 divided by an estimated useful life of 25 years. Or we have the depreciation, actual depreciation expense is 3,120 in year one and year two. So the depreciation expense is that depreciable cost, which is 78,000 spread over 25 years. And now in part B, we're going to use the double declining balance method. So again, if we're using the double declining balance method, first thing we need to know is what is the straight line rate? The straight line rate, remember, is just 100% divided by the estimated useful life. So 100% divided by the estimated useful life of 25 years. And what we end up with here is the straight line rate of 4%. And we want to double this, so we're going to multiply times 2, and it's going to equal a double declining balance rate of 8%. So the cost of the asset is not used to get the straight line rate. We want that 100% divided by 25 years. It gives us a 4% straight line rate. And we want to multiply times 2 to get the DDB rate, right? To get the DDB rate. So the straight line rate is the 4%. And when we want to find the DDB rate, it's going to equal that 4% times 2, or 8%. And once we get that DDB rate, then what we can do, in this case for year 1, is take the cost of the asset, right, as the book value. So we want to make sure that we use the book value of that asset at the beginning of the year, right? The book value of the asset at the beginning of the year. And the book value of the asset at the beginning of the year is just the cost, right? We spent $90,000 on an asset that we're going to depreciate at an 8% rate. So the amount of depreciation, right, that we need to recognize in year 1 is $7,200, right? It's the DDB rate of 8% times the book value at the beginning of the year. And then year 2, what's happening is we need DDB for the second year, right? So basically, it's going to be the same calculation, right? We need to know the DDB formula, right? Because we're going to have to calculate that depreciation again. So now what we have here is second year, we need to be able to determine what the book value is. Well, the book value is, in this case, in year 2, it's the 90,000, right? Minus the accumulated depreciation. So 90,000 minus the accumulated depreciation. And I want to put brackets around this too, because that's the book value. That's how you're going to get book value. And once you get that, right, once you get the book value minus the beginning of year book value, right, minus the cumulative depreciation, that'll give you the book value for this current year. So, and we want to multiply that times whatever that DDB rate is, which is 8%. So what do we have here? We're going to need here this $90,000, right? Minus the accumulated depreciation in the first year of 7,200, right? And what we want to do once we get that book value is multiply it times 8%. Multiply it times 8%. So we essentially here have 82,800 times 8%. which is in year 2, 6,624. So the straight line depreciation is just the depreciable cost minus salvage, spread over the estimated useful life. Same number each year, 3,120. But now when we look at the DDB method, we have to first find the rate. 100% divided by the 25 years gives us 4%. 4% times 2 is 8%. And double declining balance depreciation is going to be the book value, which is just the cost times that 8%, 7,200. Year 2 is the book value at the beginning of the year, which is the 90,000 minus the 7,200, again times 8%. And then the last one here is depletion. So we need to record the depletion adjusting entry on December 31. So the first thing we need is the depletion rate, right? The depletion rate is, for our purposes, cost spread over the amount of the deposits in that natural resource, right? So the cost that cost spread over the deposit gives us our depletion rate. So we got a cost of 67.5, and we want to spread that over its estimated tons that will be mined over its useful life. So the estimate in this case is the 30 million tons that they anticipate being able to remove and sell. But what it means for us is now we have to well, we need to figure out what our rate is here, because I set up the equation, but I didn't put in the actual rate, which is, for our purposes, 2.25 per ton. 2.25 per ton. And the depletion expense, well, if we want to know the depletion expense, then we need to take the depletion rate times the actual removal times what we've actually removed, right? And the rate is 2.25 a ton. And we know 4 million tons were mined and sold this year. 4 million tons were mined and sold this year. So the depletion is $9 million. $9 million of depletion, which means on December 31st, we're going to be recognizing depletion expense of $9 million. And the credit is to that contra account we call accumulated depletion, which is going to be credited for $9 million. $9 million of accumulated depletion. So hopefully that will give you enough to complete your application assignment for Chapter 9 and the quiz for Chapter 9. And I will see you in our last chapter, Chapter 14.